All right, so today we're diving deep into a really interesting one, Inovalis REIT, ticker INOUN. Now, for those who don't know, a REIT is basically a company that owns and operates real estate that makes money. And on the surface, this one looks like an absolute steal. But, as we're about to see, the story here is, well, it's a lot more complicated than that. Let's get into it.
And let's just start with the number that makes everybody's head turn. This REIT is trading at a massive 66.4% discount to its net asset value. Now, what that means in plain English is that the properties it owns are supposedly worth almost 3 times its stock price. I mean, that is a huge, huge gap. So that immediately brings up the big question, right? Is this massive discount a golden opportunity, a chance to buy valuable stuff for pennies on the dollar? Or is it a classic value trap, where that super low price is actually a giant warning sign of much deeper problems? Well, that's what we're here to figure out.
To get to the bottom of it, here's our game plan. We'll start with the numbers on the surface. Then we'll do a serious deep dive into the red flags. After that, we're going to weigh the different scenarios, figure out what price you'd actually need to pay to make a decent return, and then we'll deliver our final verdict.
Okay, let's kick things off with that first glance at the valuation. What are the headline numbers telling us?
So this table really lays out the wild contrast. The share price is just 84 cents, but the company's own reported book value is over $4. Now, to be really conservative, the analysis we're using applies what's called a 40% haircut. Basically, we're just chopping a huge chunk off their valuation to be safe. That brings the net asset value down to $250, and even after that, we're still looking at that 66% discount. On paper, this thing looks incredibly cheap. But here's our first big clue that something is really off. We're looking at 2 ways to measure cash flow. You've got FFO, funds from operations, which is kind of like a broad measure. By that number, it looks, okay, reasonably priced. But then there's AFFO, adjusted funds from operations. This one's more important because it takes into account the money you got to spend to maintain the properties. And by that measure, oh man, the company looks really, really expensive. That gap between the two tells us the actual cash available to investors is a lot weaker than it first appears.
And that is our cue to go deeper. The numbers on the surface are sending mixed signals, so we got to pop the hood and see what's actually happening with the business.
Wow, okay, this chart really just gets right to the heart of the problem. You see on the left, total revenue for the year is about $17.5 million. But look at the right. The net loss is almost $56 million. I mean, how is that even possible? It means the value of their properties is being written down so badly that it's wiping out every single dollar of revenue and then some.
And here's another jaw-dropping number, 139%. This is the AFFO payout ratio. What this means is that for every dollar of real, spendable cash the company actually generates, it's paying out $1.39 in dividends. You don't have to be a math genius to know that's completely unsustainable. They're funding this by taking on debt or selling things, not from the cash their business is making.
You know, the red flags just keep piling up. The analysis shows this whole pattern of serious issues. Cash flow is going down, debt is going up while the company shrinks, that dividend is a ticking time bomb, there's a huge risk of even more write-downs, and they're facing major uncertainty with their tenants. It's a really concerning picture.
And this slide right here really puts the financial risk into perspective. The company is carrying over $200 million in debt. Meanwhile, the total value of all its shares, its market cap, is less than $28 million. That is an insane amount of leverage. It makes the whole company incredibly fragile and super sensitive to any little hiccup or change in interest rates.
So, after all that bad news, are there any positives at all? Let's move on and see how this all balances out. We need to weigh the evidence and think about what the future might actually look like.
This weighted analysis kind of does the math for us, and it paints a perfect picture. You see, the biggest strength, that deep NAV discount, yeah, it gets a lot of weight in the high score. But look at the weaknesses, like weak profitability and high leverage. They're also weighted heavily, and their scores are a pathetic 2 out of 10. So when you do all the math, that final score of just over 4 shows that the weaknesses are just completely overwhelming the few bright spots.
So, what could happen from here? Well, in the worst case or bear case scenario, all these negative trends just keep going. Revenue keeps falling, they write down more assets, and the stock price could pretty easily drop below 50 cents a share, just destroying even more shareholder value.
Now, the base case, what the analysis says is the most likely outcome, is pretty much just stagnation. You know, the bleeding stops, but there's no real recovery. The valuation just stays in the dumps, and the stock kind of treads water between 80 cents and $1. Not a total disaster, but definitely not a good investment.
And then, of course, there's the bull case, the dream scenario. This is the turnaround story. If management can somehow pull it together, get more tenants, get costs under control, then yeah, the stock could maybe double, maybe get up to $2. But let's be honest, given the mountain of problems we've just seen, that feels like a real long shot.
And this brings us to the most important question for any of us as investors. We've seen the risks, we've seen the possible outcomes. So now, let's figure out what price you'd have to pay to actually have a shot at making a decent return here.
The analysis we're looking at sets a really clear target. The goal is to earn an average of at least 9% per year over 16 years. This isn't just some vague hope for profit. It's a hard number we can actually measure against. And folks, this right here is the punchline. According to the analysis, to hit that 9% annual return over 16 years, you would need to buy this stock at 60 cents. But the current price is 84 cents. So what that tells us is, at today's price, the stock is just too expensive to meet our goal, even if we're willing to hold it for the long haul.
And that leads us right to our final verdict. After looking at the valuation, the truckload of red flags, and the price we'd need to pay, what's the ultimate takeaway? Should you invest?
This scorecard sums it up perfectly. On a scale of 1 to 10, the opportunity here is rated a pretty low 4.5. But the company gets a very low safety and quality score of just 3.2. That means this is considered a high-risk investment. Plain and simple, the analysis concludes the risk just doesn't justify the potential reward.
I think the source material puts it perfectly through the lens of one of the greatest investors ever. Charlie Munger would likely avoid due to poor quality. Munger and his partner Warren Buffett always said to buy wonderful businesses at a fair price, not fair businesses at a wonderful price. And by every measure we've seen, this does not look like a high-quality business.
So, our final verdict answers that question we asked right at the beginning. Is this a golden opportunity? No. It looks like Inovalis REIT is a distressed asset. That huge discount to its book value isn't a mistake by the market. It's an accurate reflection of some very real risks.
And that's our deep dive into Inovalis REIT. It's a fantastic reminder that you always have to look past the headline discount. So, what company should we put under the microscope next? Let us know what you want to see in the comments below. Thanks for watching.